Ladies and gentlemen, welcome to the Fiscal Philosophy YouTube channel. Crowdstrike has been getting smashed as of late due to the fact that, well, late last night, early this morning, computers worldwide got knocked out due to a patch with their security software. Mostly it was Windows machines affected. This, of course, sent the stock tumbling in the pre-market trading, and it has maintained this sort of downward trajectory, down 9% as of the time of this recording. Also, my Schwab account is affected. I can't really see or do much there right now. Computers where I work were affected. Airlines were affected. It's pretty bad. Considering that this is a fast-growing, high-margin business that suddenly experienced a rapid drop in stock price, people might be asking, hey, is this now a value opportunity? As you can see, their revenue growth is in a 40-degree angle, straight right and upward, pretty much every single quarter. Considering that this is a fast-growing, high-margin business that suddenly experienced a rapid drop in stock price, people might be asking, hey, is this now a value opportunity? However, on the flip side, you also have the selling, general, and admin costs going up at a similar trajectory. In fact, it's almost 50% of their revenue is being eaten up by the selling, general, and admin costs. That being said, free cash flow appears to be growing at just as fast a pace as anything else in the business. And we do like to see growing free cash flow. After all, this is how they return value to shareholders, pay off debts, all that good stuff. The valuation is definitely a concern. You see this massive difference between their price to earnings ratio of 5 to 83 versus their price to free cash flow of about 72. This, I would say, first instinct, stock-based compensation is the cause of it. The other question that would be on my mind here is 72 times free cash flow a good multiple to pay for this company, or is that expensive? It comes down to where you see the free cash flow going in the future. If it grows rapidly, it might be worth this today to get that future growth. Now, it would take quite a lot of growth, I think, to justify this valuation, but we saw that upward right 45-degree angle in revenue. So perhaps with the high margins you get in software, we're getting somewhere near that growth rate that we need to justify this value. Earlier, we mentioned that the PE was way higher than the price to free cash flow, and that's because PE is based off of net income, which takes into account stock-based compensation. And as you can see, the stock-based comp is pretty rich for this business and their level of revenue. One advantage of using stock instead of cash to pay employees is it lets them build up a pretty solid balance sheet where they could pay off all their long-term debt and still have almost $3 billion left over, which, hey, that's not a bad position to be in. It's hard for your business to go bankrupt when you've got billions of dollars in the bank and don't have a ton of debt. So from that perspective, it could be seen as a good thing. The big question on my mind, of course, is will this still be considered a strong buy from analysts after everybody has a chance to digest today's news with their patch, and will they lose any customers? If they won't, then maybe it's a buying opportunity, as analysts have a high price target of 440 on this in the next 12 months with an average of 378. So they view it, at least prior to this, as a good stock to buy at today's price. For the most part, there is that one low end target of $200, but that seems to be a minority opinion. And now is one of my fun little thought exercises. What would they have to do to justify today's valuation? Well, first, they would have to hit 2026's analyst EPS price or earnings per share target of $6.58 per share. We'd have to apply a 10% discount rate. And then over the next 10 years, they would have to compound that earnings at 22.25%. That is no small task. Now, can they do it? Maybe, maybe not. Now, if they do, and then it slows to a high single digit, yes, today's price seems to make sense. And what the bulls would tell you, and there might be something to this, is, hey, if this is still a 75% gross margin software business and they're still growing at high single digits, the market probably is going to give them a premium multiple even 10, 20 years down the line. So this is why it's worth paying this price today for that rapid growth they're going to have over the next few years. And I totally get that. I just don't think I'm quite on board yet. My audience tends to be a little bit more value side of things, goes more towards things like staples that when they're cheap, like consumer staples like tobacco and consumer goods, REITs, asset plays, stuff like that, dividend pairs. So let me know if you happen to have any CrowdStrike. I'd be curious to hear from you. Be sure to comment below with your input on CrowdStrike stock. Is this a buying opportunity, or are customers going to flee them after today's outages? That's the question. Don't forget to like the video for the algorithm, subscribe for more. Make sure you follow me on Twitter at Mr. Macho Mog. Join my Discord, link in the description. Follow Cashflow Kings Live. I go on every Saturday, 8 p.m. Eastern. Take it easy, everyone.